Hey.
Hey everyone, Ryan Bolton here, ryanbolton.com, local mortgage expert, answering your real estate and mortgage questions. So let's jump right into some questions. First one I like here, is it bad to get multiple mortgage pre-approvals? I would say no. You're shopping for a mortgage, which is one of the biggest debts you'll ever have. One of the bigger financial decisions you'll make is buying a home. So getting a couple other pre-approvals, or at least getting a couple other quotes, would be a good thing. The downside is if you ding your credit every single time, that can affect your situation. But most of the credit bureaus now allow what's known as a shopping period, to where if you pull an inquiry within a certain time frame and a certain number, it only counts as one inquiry. Once you pass that waiting period or pass a certain number of inquiries, then it can hit you a little bit more. Now, I've had people ask me all the time, why is there hits to pull your credit? It's basically allowing time for whatever you did with that inquiry to actually report to the credit bureaus. So let's say, for instance, you go out and have 5 car loan pre-approvals or car loan inquiries. They don't know if you went out and got 5 car loans. Probably most likely it's only one. But if you all of a sudden have just a bunch of inquiries showing up for cars and insurance and trucks and all of this stuff, homes, they don't know what happens with those inquiries until a little bit of time filters out. Now, after 90 days, it usually doesn't affect your score at all. I've had people that say, well, I don't want to pull my credit. I don't want to pull my credit. And they haven't pulled it in years, even, months and months or even years. And it's really such a crucial part of getting the pre-approval is pulling the credit report. But as far as getting multiple ones, I think it's worth shopping, or at least get a couple different quotes. Maybe you don't have to have everybody pull your credit like crazy if you can get at least your credit score. But to make the pre-approval really stick, pulling a credit is a big part of that. So question again, is it bad to get multiple pre-approvals? No, it's always good to shop. You may not need to pull your credit every single time, but it's definitely worth shopping different loans. And that's really one of my big jobs, is to see what lenders are offering what terms for every particular client. I don't give my client just one option. We always go through kind of option A, B, and C to see which ones are the best options. So part of my job is to do some of that shopping for you, so we make sure we get you the best loan that's out there. Next one. Do buyers need to get pre-approved for a mortgage loan before they can view a house in person? They don't have to. There's not like a law or any requirement that you have to, but you should. You really, really should get pre-approved first. And the main idea is to make sure there's no red flags or debt ratio issues, that you're not looking at a home that you can't get pre-approved for, or looking at a home that's going to be way more expensive than what you really want to pay per month. So I'm amazed that a lot of people will start the buying process before they start the pre-approval process. And you really, really should start there. In fact, most lenders, most builders, most sellers, real estate agents, they want to see that pre-approval. They want to see you've taken that first step to talk with a local lender or talk with a lender and find out what you're pre-approved for. I can't tell you how many times people go look at a house, then they get pre-approved and get discouraged because the payment's way more, or they're not approved, or they're just looking at the wrong house. But I've seen the flip side of it, where people think, oh, I only can afford a $250,000 house, and we can tweak the numbers or tweak the down payment or do something to help them get into a higher category, which may open up a whole new home bracket for them, maybe more square footage or a bigger yard or a 3-car garage, or those types of things that can open up if you can get your price range up a little bit. So you don't have to, but you really, really should, almost to the point where you have to. It's almost right to that point where start with the pre-approval. And I'd love to help you with that. So if you're looking for a home loan in Utah or Nevada, those are the states that I lend in. You can go to my website. It's down at the bottom there, ryanbolton.com. You can set an appointment right on my website, or even download my mobile app, and we can get started right then, get you a pre-approval, and just review all your options so you can start going out there with confidence. Another thing I would say is, if you haven't started the pre-approval process, your offer may not stand out as much because you need more time. Where if you do the pre-approval stuff first, you're getting your ducks in a row, you can put a much, much shorter time frame on the contract, which may help it stand out more. If somebody else is asking for 30 days to close and you only need 14 or 20 or less, maybe they're more likely to take your offer first. So pre-approval first. Get with the lender, get with me. Let's start that pre-approval process first. All right, let's go through some more questions here. Let's see. If I buy a house in an up market, can you still do a cash out refi if the value of the home goes down due to market trends? Yes, it just depends on what you owe versus what it's worth. When you do a cash out refi, it's typically a lower loan to value than when you purchase the home. Like purchase loans go up all the way up to 100%. You can put 5% down on a purchase, where most cash out refis, they want to see it under 85%, in most cases, even under 80 and 75% of the value of the home. So it really depends on what you owe on the home versus what it's worth, that you can do a cash out refi, or really any kind of refi where you're getting money back out. Now, anything over $2,000 in your pocket is considered a cash out refi, or paying off debts. So a second mortgage, a car loan, a visa, anything above the first mortgage lien or the second mortgage lien if it was used to buy the home. So if you bought a home with the first and the second, then you can roll those together and be a rate and term refinance. If it's something where you bought the home 5 or 6 years ago and you got a line of credit last year and you're trying to combine those two things and not really get any money in your pocket, just covering the mortgages, that's still classified as a cash out refi. So the higher loan to value and better interest rates are always going to be purchase, then rate and term refi, then cash out refi. And cash out is a little different terminology in the mortgage industry, what we classify as a cash out refi. It's anything where you're paying off any other debts other than the liens acquiring the home, and anything more than $2,000 in your pocket. Closing costs can be included. So you can roll in the points and fees and title appraisal. You can put all that as part of the loan, and that's still considered a rate and term refi. It's just anything in your pocket outside of up to $2,000. Let's go for another question here. Is it better to get a second mortgage from your mortgage holder or from a separate lender? I get this question a lot. It's kind of similar to, should I refinance with the current lender that I currently have, or should I shop it around with other lenders? Keep in mind, most first mortgages are sold as securities. The loan you probably have right now, the one you're making the payment to, was probably not the lender that started the loan. You may have originated the loan with a bank or a credit union or a broker or something like that, and the servicing has already been sold. So really, it's a whole new loan when you refinance anyway. They won't really save you any time or paperwork to refinance with your existing lender, because they still need to update pay stubs, W-2s, all those things. So you don't really see any kind of major benefit there. They may waive a couple fees, but generally speaking, I've had borrowers come in with their current lender offer, and we're always able to beat it. So it is something where it's good to shop that around, because you're tapping into other money sources that maybe your current lender as a servicer doesn't have as many options with, where we have everybody out there lending mortgages we have access to. So we can really shop day to day which lenders are offering which program and what interest rates are available. So to go back to this question, is it better to get a second mortgage from the mortgage holder or a separate lender? I would also say this: a lot of first mortgage companies don't do second mortgages, don't do lines of credit, because they're a little different animal, how they're securitized and underwritten, that kind of thing. So you might as well check, but just like anything else, they may be better. Generally speaking, a separate lender, I think, will be better, because they'll specialize in second mortgages and not just as a secondary thing. So it's always good to shop around, whether it's a first mortgage or a second mortgage. And why we call it a first and second, while we're on the topic, a first is typically, it doesn't mean it's your biggest loan. It doesn't mean that it's your loan that you first got. It's the first lien against the property. And why that's significant is, if you go into a foreclosure situation, that's the first guy to get paid off when they sell the home on the courtyard steps. Certain things can jump ahead of that first lien, like property taxes or HOAs or certain judgments, depending on their timing, that type of thing. But generally speaking, it's the safest lien on the property, because if something does go wrong and gets into foreclosure, it gets paid off. Where, let's say the first mortgage is foreclosing on the home, the second mortgage could potentially lose their money. They could not get any proceeds from the sale of the home, because they're already in that second lien position. So they have to go after the borrower with like a judgment or something like that. But that's why that first lien is so important. It doesn't mean it has to be like your biggest loan or a fixed rate. It doesn't matter the type of lien. It's position if it goes into foreclosure. All right, let's go into more topics here. Excuse me. Okay. What is mortgage insurance? What happens if you don't pay it? That's interesting. So when we hear insurances, you're going to have car insurance, you're going to have homeowners insurance, renters insurance, cell phone insurance. I mean, insurance is everywhere. It really drives the world. It really helps to spread the risk out, which makes investing and doing things better, or at least safer, to offset risk. So mortgage insurance protects the lender that if you default on the loan, they go through that foreclosure process. This helps them to recoup some of their losses in that process. When it says, what if you don't pay it? It's built into your payment. So when you're making your mortgage payment, unless you're specifically cutting your mortgage payment by the exact amount of the mortgage insurance, it's just built in your payment. So if you don't make your mortgage payment, you're not making your mortgage insurance payment, but the mortgage insurance is still there. So it's still protecting the lender from day one, regardless if you go 2 or 3 months and all of a sudden stop making your mortgage payment. So in most cases, obviously, it could be years before a loan goes into foreclosure. Hopefully never goes into foreclosure, obviously. But mortgage insurance isn't something where, like on car insurance, if you stop paying, your coverage goes away, or they give you warnings and stuff like that. It works a little differently. Once that mortgage insurance is in place, it's in place but the premium's paid out of the mortgage payment. So once the mortgage payment stops being made, then it goes into default. That's when they can put the claim into the insurance. So that's how mortgage insurance works a little bit differently as far as payment. Let's see. How are we doing on time? Sorry. Okay. About 10 minutes into this, 11 minutes. How long do you have to work at a job to qualify for a mortgage? You can be as little as 1 day on the job, depending on how you're paid, depending on what type of industry. So there is some criteria with that. But there's certain loans out there. If you've been going to school for 2 or 3 years and now you're in the field that you're in, you can literally be 1 day on the job. We can use that income. If you switch jobs, it can be a little bit different on what type of income we can use. The biggest trick is if it's salary versus commission, bonus, overtime. A lot of that stuff we can't count. So if it's something where the job is all commission, you're going from maybe hourly or salary to a full commission job, that's where we need more history. Or if you go from W-2 to self-employed or 1099. So there's so many different ways people work and jobs and earn income out there. There literally is a guideline for every one of those situations. So they're all a little bit different. But the question basically says, how long do you have to work at a job? It can be as little as 1 day or as much as 2 years, depending on the type of job and how the income is earned. W-2 versus 1099, tips versus salary versus overtime versus bonus. Most of that stuff we can't use until there's a 2-year history of it. But as far as a base salary, making $20 an hour, $40 an hour, whatever the hourly wage is, we can use that right off the bat. So I've actually done loans where the client didn't even start their job until the day we close like the loan, and we're able to make that work. So there is ways to make it work. Let's see. When does it make sense to pay for mortgage points? So points are a percentage of the loan. So if it's 1 point, it's 1% of the loan. So if it's a $200,000 loan, that's $2,000 to buy 1 point. Now, how much does that get you? It depends on any given day, and it changes. So maybe going from, say, 6% to 5.875, 1 day might cost only a quarter, 1 day might cost 2 points, depending on where the yield curves are, that type of thing. So generally speaking, 1 point doesn't just always buy you a 0.25% in rate or an eighth of point in rate or any of that type of stuff. But a point is a percentage of the loan, not the sales price. So it is of the loan. So keep that in mind. It's a percentage of that. When it makes sense is I always do the math on it. Here's a simple math calculation. Take what the payment is at the higher rate, the payment at the lower rate, and minus those two numbers. So let's say it's $50. Then take the cost to get those rate differences. If it's $2,000 and it saves you $50 a month, where is that break-even point? That's 3 years. So if it's 3 years, are you going to keep the home that long? If you're not, don't buy down the points. If you are, that's when it makes sense to buy down the points. So you just have to know what it costs. And like I said, I've seen it to where it's 1.468% or 1.2046%. I mean, it's never exactly zero, just like gas prices or anything else, or stock prices. They're never exactly $1. They're going to be fluctuating every day. So that's where it makes sense to pay points, is when you're going to keep the home long enough to where that rate savings really kicks in. Now, I have people tell me all the time, well, over 30 years, it's going to save you money. But sure. But the first 5 years, you're just paying yourself back, and you sell the home or you refinance or don't plan on keeping the home that long. Maybe you know you're going to have more kids, or the kids are going to move out, or you're not sure if your job's going to be at a particular place. Most people keep their home about 7 years as the average. I think that's been ticking up a little bit, closer to 10 years. I've seen as low as 5 years. Most people don't keep it 30 years or keep it forever. So keep that in mind as well when paying points, is really how long do you plan on keeping it? Now, things can change, obviously. So you may not know. You may be some, I really don't know. But other people just know I don't have any plans to ever move. This is going to be our final last house. That's where some points can make a difference. All right, we're about 15 minutes here. Let's do maybe a couple more. Hope you're enjoying the video. Got a bunch of these on my web channel here, or my channel on YouTube. I got some other topics that I do, other little Q&A videos. I do how-to videos. I do why buying a home. So check out the other videos on the channel. I'd love to have your feedback, comments, subscribe, and topics. If you have other questions you'd like answered, please put them in the comments. We'll compile those and put those in the next videos. Let's do a couple more. What is the foreclosure auction date? So this is typically after the waiting periods are established. So once a home goes into default, you have to give what's called a notice of default, commonly called an NOD, that notifies the county, notifies all the regulatory things you have to do to start a waiting period. Here in Utah, it's 90 days. So they have to say, okay, you are now in notice of default. You have not made your payment. We'll start that 90-day process. During that 90 days, you might try to work with the lender, try to modify the loan terms, try to short sell the home, try to sell the home, whatever is going to happen. Many people wait way too long into that process, by the way. And many people think that, oh, I'm talking to the lender, we're working on the modification, that it stops that waiting period. It doesn't. The lender wants to get some of that stuff out of the way. Even if you resolve the situation, even if you get the payment reinstated, catch up the payment, whatever, they're not going to stop the waiting periods. They want to keep those, get them out of the way, so then they can go into the foreclosure if it comes to that. The last thing they want to do is start the NOD, stop it because you're working on modification. The modification doesn't go through or the terms don't work out. Then they have to start the 90 days over again. Where if they start the 90 days, that can all be kind of clock be ticking on that while they're doing everything else to save the loan or help you move out or whatever you're going to do. So typically the foreclosure auction date is past all the waiting periods. They've done the public notices where investors or other buyers can know that the home is at that stage. That's when the auction actually starts. This is where the lender will typically bid on what's owed. And if somebody outbids it, then they get the home. And typically if it's something where they're upside down or they owe more than what the market's going to sell for, that's when the lender then gets the home and the owner's gone, and now it becomes part of their schedule of real estate, part of their REO schedule of real estate. So this is where they can sell it at other paces. They can pull it with other things. They can do all kinds of different stuff. So there's a lot of different steps depending on who the lender is, depending on if it's insured, all that type of stuff. But the short answer, what is the foreclosure auction date? That's the date where the bank is trying to get their money back, sell it to an investor, or basically buy it back and clear off the title of any other owners. All right, let's go. We're 19 minutes. Let's even fit one more in here. How does marriage affect mortgages? Oh, how does marriage affect mortgages? Well, it depends on if they're on the loan or on the property. So if you, that's an interesting. How does marriage affect mortgages? Well, they're owner of the home, they're owner of the mortgage. If they did the loan together, if you're not married, then get married, it doesn't mean they get automatically added to the mortgage, even if you add them to the property or the title report. So how does marriage affect mortgages? Oh, holy moly. Drop my little camera. Oh man, blooper reel. Okay. Yeah. How does marriage affect mortgage? It affects everything. All for the better. All right, let's do one more. Is it possible to get a new mortgage after paying off an old one? Sure. Why would you think you couldn't? Is it possible to get a new mortgage after paying off the old one? Yeah. Just got to qualify, just like any other loan. Loan guidelines might have changed from the loan you did before. You'll still have to income qualify. All that doesn't mean that once the loan's paid off, you just get to reinstate that old loan or that old interest rate or anything like that. So it's just like applying for a new refinance or a new mortgage loan. So there really isn't any reason why you couldn't. You just have to qualify, just like anything, just like a car loan. If you pay off a car, you can still get another loan against the same car. So, yeah. We're just under 20 minutes. How can someone avoid mortgage regret? Is that a thing? Mortgage regret. Why would you regret? I guess maybe paying too much points and fees, um, getting a mortgage in the first place. I I don't know. Oh, is that a thing? Please comment below. Do you have mortgage regret? I I love my mortgages because it allowed me to own rental properties, allowed me to own my current home. I'm going to have a housing expense either way. Why not own it? The only thing I can think of is maybe there's a lot. I mean, boy, this is all live. I mean, I'm obviously going to post the video later on, but I'm just going from the cuff here, just trying to answer questions. That's what it is. So there's sometimes really funny ones, and you're fun. It's interesting if you think about the person sitting there typing the question, hitting send. You obviously they have some sort of further explanation of their question in their mind, but they just kind of post it quickly, and it's interesting to see what questions pop up here. So let's do one more. Hope you're having fun with the videos. I really do have fun answering questions. I'm on here all the time, just kind of answering questions for people. So I like what I do for a living and enjoy helping people out with their home loans and buying real estate. It's part of the fun of doing what I do. So, I gotta quit playing with this thing. I got a better microphone. So hopefully that's better. I might need to get a better camera. All right, we'll do one more. What is the minimum income required to pay mortgage insurance? It isn't an income thing necessarily, other than debt ratio for what you qualify for the premium can be affected by your debt ratio, but there isn't a minimum income required to pay mortgage. And it's more based on the loan to value that you're borrowing. It's more based on risk of the loan to value than your income. Other than if you have a very high debt ratio, maybe the mortgage insurance has to be more to offset the risk of that. But almost every time it's going to be based on 5% increments on the loan to value or the loan to sales price. So here's another really important distinction. Let's say you're buying a home at 400,000, but it's worth 450, and you don't get to use that 50,000 difference. It's based on the loan to value, or the loan to value is based on the sales price or appraisal, whichever's less. So if you're 400,000 again, the value's 450, but you're only putting 5% down, then you're still at 95% loan to value, even though you do have more technically equity than that. So it's always the lesser of the two. So mortgage insurance is really tied to 5% increments, tied to credit score. They do factor in debt ratio as part of what the premium is, but the biggest part of the premium by far is loan to value, what you are borrowing versus what it's worth or what you're buying it for, whichever's less. All right, that was 20. I try to keep these about 20 minutes, so we'll end this one. We'll do another one here shortly. I hope you enjoyed the video. Sorry about the camera. Hope the microphone's doing a little bit better, but love a chance to work with you. If you're looking to buy a home in Utah or Nevada, that's where I'm licensed. My office is in southern Utah. You can go to my website at ryanbolton.com. It should just be below here on the bottom. You can, there's a scheduler right at the top. So you can click that, see what my schedule is, book an appointment to do a phone call or meeting in my office. I also have a mobile app. You can download that and get started. But I can do a total free review, give you an idea what you qualify for, what programs you qualify for, talk about the area, all that stuff. I really enjoy what I do for a living, so I'd love a chance to work with you on buying a home. Check out my website, ryanbolton.com. Click and subscribe, make comments. Love to see you, and look forward to doing another video. Thanks.